You have $500 left at the end of the month. Should you put it into savings? Should you use it to pay off debt? Or should you invest it? All three choices sound responsible, but the order matters. Invest too early, and one unexpected bill could force you right back into debt. Focus only on debt, and you may miss an employer match or delay investing for years. Save too much in cash, and your long-term goals may never get the attention they need. By the end of this video, you will have a practical 7-step framework for deciding where your next dollar should go. This video is for general educational purposes. Your best decision may depend on your income, taxes, employee benefits, interest rates, and personal circumstances. Let's begin with the mistake that creates most of the confusion. There is no single order that works for every household. A person with no emergency savings and a credit card charging 24% interest is in a very different position from someone with 6 months of expenses saved, no consumer debt, and a strong employer retirement match. So instead of memorizing one rigid rule, we are going to use a decision system. Step 1. Keep your financial foundation from cracking. Before saving aggressively, paying extra on debt, or investing, make sure your essential obligations are current. That usually means housing, utilities, food, transportation, insurance, taxes, and at least the minimum payment on every debt. Why do minimum payments matter? Because a missed payment can create late fees, damage your credit, and make an already difficult situation more expensive. This step is not exciting. It will not make a dramatic thumbnail, but wealth does not begin with a stock pick. It begins with stability. If your monthly income does not cover your essential expenses and minimum payments, your next dollar should usually go toward closing that gap. That may require cutting a major expense, negotiating a bill, changing a payment arrangement, or increasing your income. Investing is not the first priority while your basic financial system is running at a monthly loss. Step 2. Build a starter emergency buffer. Do not confuse a starter buffer with a complete emergency fund. Your first goal is simply to create enough breathing room so that a small surprise does not immediately send you back to a credit card. That surprise might be a car repair, a medical copay, a broken appliance, or a few days of missed work. Recent Federal Reserve data shows that only 63% of US adults said they could cover a $400 emergency expense using cash or its equivalent. That is why a small cash buffer can matter before you attack every other financial goal. Without savings, even a relatively small financial shock can become debt and create longer-lasting financial damage. There is no magic starter number for everyone. For one household, $1,000 may cover the most likely surprise. For another, the better first target may be one insurance deductible, 1 month of essential bills, or the cost of a major car repair. Ask yourself one question. What is the most likely expense that could push me back into high-interest debt? Build enough cash to reduce that risk. Keep this money somewhere safe and accessible. An emergency fund is not designed to produce the highest possible return. Its job is to be available when life does not follow the plan. Step 3. Check for an employer retirement match. If your employer offers a 401k, 403b, or a similar retirement plan, read the match formula carefully. A match means your employer may contribute money when you contribute part of your paycheck. For example, imagine your company matches 50 cents for every dollar you contribute up to 5% of your salary. If you earn $60,000 and contribute $3,000 during the year, your employer could add another $1,500 under that formula. That changes the decision. You are no longer simply comparing debt with investing. You are also deciding whether to leave part of your employee compensation unused. But do not guess. Check the actual terms of your employer's plan. Learn how much you must contribute to receive the full match. Also, check the vesting schedule. Vesting determines when employer contributions become fully yours. Some plans allow those contributions to become yours gradually over several years. If your essential bills are current and you have a basic cash buffer, capturing an available employer match may deserve priority. Step 4. Attack high-interest consumer debt. Once your basic foundation and employer match have been addressed, high-interest debt usually becomes the financial emergency. Credit card debt is the clearest example. Suppose you carry a $5,000 balance at a 24% annual percentage rate. At the beginning, that rate can create roughly $100 of interest in a single month before you make meaningful progress on the balance. Paying down that debt gives you a predictable benefit. You prevent future interest from being charged on the amount you eliminate. Investing is different. Market returns are uncertain, especially over short periods. You may earn money, you may lose money, or your investment may show very little change. That does not mean you should never invest while carrying debt. It means you should compare the cost of the debt with the value and certainty of the investment opportunity. For high-interest credit cards, payday loans, and similar debt, the math usually argues for aggressive repayment. One common approach is the debt avalanche. Make the minimum payment on every balance, then direct your extra money toward the debt with the highest interest rate. When that balance is gone, move the same payment to the debt with the next highest rate. Another approach is the debt snowball. With the snowball, you target the smallest balance first. Regardless of the interest rate, the snowball may create faster psychological wins. But the highest interest rate method will generally reduce your interest costs more efficiently. The best method is the one you can follow consistently. Just understand the trade-off before choosing. Step 5. Build the full emergency fund. After high interest debt is under control, expand your starter buffer into a complete emergency fund. You may have heard that everyone needs 3 to 6 months of expenses. Treat that as a starting range, not a universal law. Your target should depend on your actual risk. A household with 2 stable incomes, strong insurance, low fixed expenses, and no dependents may need less cash than a single income household with children, variable commissions, a high medical deductible, and an older car. Self-employed workers may need a larger buffer because their income can change from month to month. Homeowners may need more than renters because roofs, heating systems, and plumbing do not ask for permission before they fail. Calculate your emergency fund using essential expenses, not your complete lifestyle. Include housing, basic food, insurance, transportation, utilities, minimum debt payments, and necessary health care. Then ask yourself this question: how long could I cover these expenses if my income stopped tomorrow? That answer tells you what your emergency fund is actually protecting. Step 6. Expand long-term investing. Once you have controlled high-interest debt and built meaningful cash reserves, your next dollars can work more aggressively toward your future. This is where you evaluate tax-advantaged accounts, such as a 401k, traditional IRA, Roth IRA, or health savings account if you're eligible. Remember this important distinction. An account is not the same thing as an investment. A Roth IRA, for example, is an account with specific tax rules. After you put money into it, you still need to choose what that money will be invested in. For many long-term investors, diversified funds may provide a simpler foundation than trying to predict a small number of individual winning stocks. Diversification does not prevent all losses, but it can reduce the risk created by concentrating your money in too few investments. Investment fees also matter because higher costs reduce the portion of your returns that remains in your account. The correct account order depends on several factors: your employer plan, the available investment options, the fees, your tax situation, your income, and whether you have access to a health savings account. The important point is this: do not wait for your financial life to become perfect before investing. Once the dangerous parts of your financial system are controlled, consistent contributions generally matter more than waiting for the perfect moment to begin. Automating those contributions can also reduce repeated decision-making. Money that moves automatically is less likely to be spent accidentally. Step 7. Balance lower interest debt with other goals. Not every debt deserves the same urgency. A credit card at 24% is not the same as a fixed-rate mortgage at 4%. Once your high-interest debt is gone, your emergency fund is established, and retirement investing is underway, the decision becomes more personal. You may choose to pay extra on your mortgage because becoming debt-free gives you peace of mind. You may invest more because your time horizon is long and the debt rate is relatively low. Or you may split the difference. For example, imagine you have $400 available every month. You could direct $200 toward additional investing and $200 toward the loan principal. That may not be the mathematically perfect solution in every situation, but it can be a practical compromise between growth and certainty. Also, consider your timeline. Money needed for a home down payment in 2 years should not be treated like money intended for retirement in 30 years. Your timeline changes the amount of investment risk you can reasonably accept. 3. Realistic household examples. Now let's apply the framework to 3 hypothetical American households. Example 1, Sarah. Sarah has no emergency savings. She has $3,000 on a credit card charging 27% interest. Her employer also matches her 401k contributions up to 4% of her pay. Her first move is not to invest every extra dollar. She keeps her bills and minimum payments current. She builds a small starter emergency buffer. If her monthly cash flow can support it, she contributes enough to capture the available employer match. Then she attacks the credit card balance aggressively. After the card is gone, she completes her emergency fund and increases her retirement contributions. Example 2, Michael and Lauren. Michael and Lauren have 3 months of essential expenses saved. They carry no credit card balance. They have a student loan at 5%, and they both receive employer retirement matches. They may decide to capture both matches, continue expanding their emergency savings, invest for retirement, and make their regular student loan payments at the same time. Their lower interest debt does not necessarily require stopping every other financial goal. Example 3, Jason. Jason is self-employed and his income changes every month. He has no employer retirement match and no high interest debt. For Jason, a larger cash reserve may deserve priority before aggressive investing. He also needs to keep money for taxes and business expenses separate. Money reserved for taxes is not an emergency fund. Once those reserves are stable, he can evaluate an IRA or a retirement plan designed for self-employed workers. Same question, different answer. That is why the right order is a framework, not a slogan. The 5-number action plan. Here's your action plan. Write down 5 numbers. Number 1, how much money is left after your essential monthly expenses and minimum debt payments? Number 2, how much accessible emergency cash do you have today? Number 3, what are the balances and interest rates on every debt? Number 4, does your employer offer a retirement match? And what must you contribute to receive all of it? Number 5, what major expense or income disruption is most likely during the next year? Now identify the first unfinished step in the framework. Do not try to solve all 7 steps this weekend. Complete the next step, then move forward. Final summary. The order once again is this. Keep your essential obligations current. Build a starter emergency buffer. Evaluate your employer retirement match. Eliminate high-interest consumer debt. Complete your emergency fund. Expand long-term investing. Then balance lower interest debt with your other financial goals. The purpose of this system is not to create a perfect financial life overnight. It is to make sure each dollar strengthens the next one. Because lasting wealth is rarely built through one dramatic decision. It is built by putting ordinary dollars in the right order, month after month. In the next Wealth for Legacy video, we will break down how much emergency savings you actually need based on your income stability, household risks, and essential expenses. Subscribe to Wealth for Legacy for practical financial education that helps you build wealth, protect it, and pass opportunity forward. Keep building your legacy.